The final alert: why someone could be trying to collapse the silver market. What happens next? February 6th, 2025, Shanghai. A silver position larger than an entire exchange's warehouse inventory. Frozen, not gradually, instantly. The official story: routine volatility management. The data suggests something else entirely. 3 major banks quietly repositioned in the 72 hours prior. Industrial buyers began hoarding physical metal 48 hours before the freeze. And someone with access to information most don't have, built the largest concentrated short position in silver market history, right before everything stopped. This wasn't an accident. This was either the most catastrophic miscalculation in modern commodity trading, or the opening move in something far more calculated. What comes next will determine whether your business survives what's being set in motion. Welcome to Metal and Macro. If you've spent decades watching markets, if you remember when a handshake still meant something in business, then you understand that what gets reported and what actually happens are rarely the same thing. We'd be grateful if you'd subscribe, the way you'd ask a trusted colleague to stay informed. And before we go further, leave a comment telling us where you're watching from today. Geography matters in what's unfolding. Now, let's examine what actually happened in Shanghai. On the morning of February 6, 2025, traders at the Shanghai Futures Exchange witnessed something they had not seen in over a decade. A single account, holding a short position in silver futures, was frozen. Not suspended for review, not flagged for monitoring, frozen. The position could not be expanded. It could not be reduced. It simply stopped. The size of this position remains the subject of intense speculation. What is known, what can be verified through exchange data, is that the short exposure exceeded the total reported silver inventory sitting in Shanghai Futures Exchange approved warehouses. Think about that for a moment. Someone had bet against more silver than the exchange itself could physically deliver. This was not a small miscalculation. This was structural asymmetry. Exchange officials released a brief statement. The language was careful, measured. They cited abnormal trading activity and referenced their obligation to maintain orderly market conditions. The statement mentioned volatility. It mentioned risk management protocols. What it did not mention was how such a position was allowed to develop in the first place. Within hours, the story spread across trading desks in London, New York, Hong Kong. Silver prices, which had been climbing steadily for weeks, suddenly jerked downward. Not a collapse, not a crash, just enough movement to signal that something fundamental had shifted. Volume spiked. Options traders began pricing in scenarios that had seemed unlikely just days before. But here is what made this different from typical market events. The freeze did not occur during a panic. It occurred during what appeared to be normal trading conditions. No geopolitical crisis had erupted overnight. No central bank had made a shocking announcement. The freeze happened because someone's position had grown too large to manage within the existing market structure. Historically, exchanges intervene in commodity markets only when systemic risk becomes undeniable. The Hunt brothers in 1980, attempting to corner the silver market, saw their positions forcibly liquidated when regulators determined the market itself was at risk. In March 2022, the London Metal Exchange took the extraordinary step of canceling nickel trades after a Chinese metals tycoon faced potentially unlimited losses on short positions. Both cases shared a common thread. The position had become larger than the market's ability to absorb it. The Shanghai freeze fits this pattern, but with one critical difference. In previous interventions, positions were public, visible, widely discussed before regulators acted. This time, the freeze appeared to catch even seasoned market participants by surprise. That suggests either exceptional operational secrecy or a position that grew far faster than monitoring systems anticipated. Market data from the week preceding the freeze reveals unusual patterns. Hope and interest in silver futures contracts had been climbing. Nothing dramatic, nothing that would typically trigger alarms. But beneath the surface, in the distribution of those positions, concentration was building. A small number of accounts were accumulating short exposure while the broader market showed relatively balanced positioning. Cross-market indicators told a similar story. The gold to silver ratio, a measure watched closely by precious metals traders, had been moving in ways that suggested silver was under unusual pressure, despite strong physical demand from industrial buyers, solar panel manufacturers, electronics producers, medical equipment suppliers. All reported tight physical markets and rising premiums for immediate delivery. Yet futures prices were not reflecting this physical tightness. That divergence between what the paper market suggested and what the physical market demonstrated is precisely the kind of structural tension that precedes market disruptions. The freeze effectively locked this tension in place. The short position could not be unwound quickly. The physical market could not easily absorb a sudden rush for delivery. The exchange had inserted itself directly into the price discovery mechanism, something markets are designed to avoid. What happened on February 6th was not simply one trader's bad day. It was a revelation of how fragile modern commodity markets have become when leverage exceeds physical reality. The position may have been frozen, but the underlying structural imbalance remains very much alive. And that imbalance did not develop in isolation. It developed within a broader economic environment that made such positioning both possible and potentially profitable. Understanding that environment is not optional for anyone with exposure to commodity markets. It is essential. Because what happens next depends entirely on forces that were set in motion long before February 6th. Markets do not break randomly. They break when stress accumulates silently, layer upon layer, until a single event exposes what was hidden beneath the surface. The Shanghai silver freeze was that event, but the conditions that made it possible began forming years earlier, in places most investors never look. Silver occupies a unique position in the global economic system. It is simultaneously a store of value and an industrial necessity. Gold can sit in a vault for centuries without losing its appeal. Oil gets consumed and must be replaced. Silver exists in both worlds. When fear rises, investors buy it. When economies expand, factories consume it. This duality creates a market that behaves unpredictably, especially when both forces activate at once. And in early 2025, both forces were active. Global recession indicators had been flashing warning signals for months. Manufacturing indices in Germany showed contraction. Chinese export data weakened. American consumer confidence surveys revealed anxiety levels not seen since the financial crisis. Central banks faced an impossible choice: raise rates and risk breaking already fragile economies, or hold steady and watch inflation expectations become unanchored. Either path led to instability. In such environments, precious metals typically attract capital-seeking safety. Investors who distrust currency stability, who question whether governments can manage debt burdens that have grown beyond historical norms, turn to physical assets. Gold receives most of the attention, but silver, with its smaller market size and industrial applications, can move more violently. Yet something unusual was happening in silver markets throughout 2024 and into early 2025. Physical demand was surging while paper prices remained surprisingly subdued. Solar panel installations were accelerating globally as governments pushed renewable energy mandates. Electric vehicle production required more silver per unit than traditional automobiles. Medical imaging equipment, 5G infrastructure, advanced electronics, all demanded silver in quantities that were straining available supply. Mining production could not keep pace. Silver is rarely mined on its own. It typically comes as a byproduct of copper, lead, and zinc operations. When those base metal prices weaken, as they had been doing throughout 2024, miners reduce output. Less copper mining means less silver production. The math is straightforward, but the market was not pricing this supply constraint into futures contracts. Why? Because someone was selling futures contracts in quantities large enough to suppress price discovery. Not occasionally, consistently. Week after week, as physical premiums rose and industrial buyers scrambled for metal, futures prices remained flat or declined. This is not how functioning markets behave. When physical tightness emerges, futures prices should rise to attract new supply or ration existing inventory. When they do not, when the disconnect persists, it indicates intervention. The Shanghai Futures Exchange had become increasingly important in global silver price formation. China is the world's largest silver consumer. Its industrial sector absorbs metal at a rate that dwarfs Western demand. What happens in Shanghai increasingly determines what happens everywhere else. And throughout 2024, Shanghai futures showed persistent selling pressure that did not align with underlying physical market conditions. Commitment of traders data from exchanges in New York told a similar story. Commercial hedgers, the mining companies and industrial users, who typically provide market liquidity, were not the source of short positioning. Instead, a category labeled managed money and another labeled other reportables showed unusual concentration. These categories often include hedge funds, commodity trading advisors, and entities whose positions are not transparent to the public. Concentration in derivatives markets creates fragility. When many participants hold similar positions, when leverage is high, when physical delivery mechanisms are strained, markets become vulnerable to sudden violent moves. One participant's forced liquidation can trigger cascading effects as counterparties scramble to adjust their own risk. Geopolitical factors added another layer of complexity. Trade tensions between major economies had not disappeared. They had simply evolved. Commodity markets became arenas where nations could exert influence without direct confrontation. Control over critical materials, the ability to disrupt supply chains, these became tools of statecraft. Silver, as both a monetary metal and an industrial input, sat at the intersection of these strategic considerations. By early February 2025, The silver market resembled a bridge carrying far more weight than its design specifications allowed. Physical demand pulling in one direction, financial positioning pushing in another, exchange mechanisms straining to maintain orderly function, leverage accumulating in concentrated positions, geopolitical tensions adding unpredictable stress. Something had to give. The freeze on February 6th was not the cause of instability. It was the symptom. It revealed that the market's internal structure had become misaligned with reality. Paper claims exceeded physical availability. Derivatives exposure exceeded the system's capacity to manage orderly settlement. Trust in price discovery mechanisms had eroded to the point where regulators felt compelled to intervene directly. This environment, this specific combination of supply constraints, demand surges, financial leverage, and geopolitical complexity, created an opportunity for profit, an opportunity for manipulation, or perhaps an opportunity to expose just how vulnerable these markets had become. Understanding whether the Shanghai position was accident or strategy requires examining who benefits and who loses when silver markets destabilize. There is a question that traders ask quietly, in conversations that do not get recorded, away from compliance officers and regulatory filings. The question is simple. When does a trade become too perfect to be accidental? The Shanghai silver freeze presents exactly this puzzle. On the surface, it appears to be a straightforward case of excessive leverage meeting inadequate risk management. A trader built a position too large. Market conditions moved against them. The exchange intervened to prevent systemic damage. Story concluded. Lesson learned. But markets leave fingerprints. Patterns emerge in the data that suggest intention, or at minimum, extraordinary coincidence. And when coincidences accumulate beyond statistical probability, analysts must consider alternative frameworks. Framework 1 assumes incompetence. A trading desk miscalculated exposure. Risk models failed to account for delivery constraints. Position limits were either ignored or inadequately enforced. The short position grew not because someone wanted it to reach dangerous levels, but because internal controls broke down. This interpretation has historical support. Long-term capital management collapsed in 1998, not because they intended to threaten the financial system, but because their models did not anticipate events their mathematics deemed impossible. Lehman Brothers did not plan to trigger a global financial crisis. They simply underestimated how quickly liquidity could evaporate. Under this framework, the Shanghai trader is a cautionary tale, a reminder that leverage amplifies not just returns but mistakes. The freeze represents regulatory competence, authorities stepping in before one entity's failure contaminated the broader market. Nothing more sinister than human error meeting mathematical reality. But Framework 1 struggles to explain certain details. Why did 3 major international banks reduce their silver exposure in the 72 hours before the freeze? Position data shows deliberate unwinding, not gradual portfolio adjustments, but targeted reduction of specifically silver-related risk. Banks do not move in coordinated fashion without information. Either they independently reached identical conclusions about silver market risk at the exact same moment, or they had access to information that prompted simultaneous action. Framework 2 proposes deliberate exploitation of market structure weaknesses. Commodity markets contain inherent vulnerabilities, physical delivery mechanisms, margin requirements, position limits. These create predictable pressure points. A sophisticated participant with sufficient capital can engineer situations where these pressure points activate in profitable ways. Short a commodity beyond available inventory. Wait for delivery month to approach. Watch as participants scrambling to fulfill contracts bid up prices, or watch as exchanges intervene and create trading opportunities in the resulting chaos. This is not theoretical. It has happened before. In 2010, armored truck companies in London faced unusual demand for physical platinum. Traders had sold futures contracts, waited until delivery approached, then intentionally failed to deliver, forcing buyers to settle in cash at manipulated prices. The scheme worked until regulators identified the pattern, but the existence of the pattern proves the strategy's viability. Applied to Shanghai, Framework 2 suggests the short position was not accidental but engineered. Build exposure slowly enough to avoid triggering alarms. Time the position to coincide with known supply constraints and elevated industrial demand. Create conditions where either price collapses under short pressure or exchange intervention creates profitable volatility. Either outcome generates returns for those positioned correctly. Evidence supporting this interpretation includes the timing. The position reached critical mass during a period when Chinese industrial demand was seasonally elevated. Solar panel manufacturers were buying aggressively ahead of installation deadlines. Electronics producers were securing inventory for spring production cycles. Physical premiums were rising, yet futures prices remained flat. That specific divergence during that specific window created ideal conditions for a leveraged short position to either profit from price suppression or force intervention. Framework. 3 moves beyond individual profit motive into geopolitical strategy. Nations accumulate commodities, not just for economic reasons, but for strategic leverage. Control over critical materials provides negotiating power. The ability to disrupt markets sends signals. Silver sits at the intersection of monetary policy and industrial necessity. A nation seeking to test Western financial market resilience, or to demonstrate its ability to influence commodity price discovery, might view a concentrated short position as an experiment. This interpretation finds support in broader patterns. Chinese state-affiliated entities have systematically acquired positions in commodity markets over the past decade: copper warehouses, rare earth processing capacity, lithium refining infrastructure. These accumulations serve multiple purposes simultaneously: securing supply for domestic industry, generating financial returns, and establishing strategic leverage. A silver position that tests exchange mechanisms and reveals market fragility fits within this broader pattern. But attribution remains impossible with publicly available information. Futures accounts can be layered through multiple entities. Offshore structures obscure beneficial ownership. What appears to be a single trader might represent multiple coordinated participants. What appears to be private speculation might mask state direction. The data reveals intention existed somewhere in the chain of decisions. The position did not grow randomly. It was built methodically. Timing was not coincidental. It aligned with specific market conditions. The result, whether intended or not, exposed fundamental fragility in how silver markets function when leverage exceeds physical reality. 3 frameworks, 3 interpretations. 1 unchanging fact: the structural vulnerability is real. Whether exploited deliberately or revealed accidentally, the same underlying instability remains. Markets operating near their functional limits do not require malicious actors to break. They simply require one participant whose position exceeds the system's absorption capacity. What matters now is not determining intent. What matters is understanding what happens when that structural vulnerability meets the economic forces already in motion. Financial markets do not pause. They do not wait for clarity before moving forward. The Shanghai position remains frozen. Derivative positions exist throughout the global system. And somewhere, decisions are being made that will determine whether this freeze becomes a footnote or a catalyst. 3 scenarios emerge from current conditions. Each carries distinct probabilities. Each demands different strategic responses. And each reveals something essential about how commodity markets function when structural limits are tested. Scenario 1, controlled unwinding. The exchange works with the frozen account to gradually reduce exposure. Physical silver is sourced from alternative warehouses. Other market participants absorb portions of the position through negotiated transfers. Prices experience moderate volatility but remain within manageable ranges. Within 60 to 90 days, the position no longer represents systemic risk. Markets return to normal function. This represents the optimistic path, but optimism requires specific conditions. It requires that the frozen position is not duplicated elsewhere, that no other accounts hold similarly concentrated exposure in Shanghai or other exchanges. It requires that physical supply can actually be mobilized to meet potential delivery obligations. It requires that counterparties remain solvent and able to fulfill their side of derivative contracts. It requires that broader economic conditions do not deteriorate in ways that stress commodity markets generally. Probability assessment, moderate, perhaps 40%. This outcome is possible if current information represents the full extent of concentration, and if industrial demand moderates sufficiently to ease physical tightness. But this scenario becomes less likely with each day that broader economic indicators weaken. Business implications under Scenario 1 are relatively benign. Companies with silver exposure should expect continued price volatility, but not structural market breakdown. Industrial users should secure supply through diversified sources, rather than relying on single exchange delivery mechanisms. Investors holding silver positions should maintain them, but avoid adding leverage. The key indicator to watch: whether Shanghai warehouse stocks begin increasing. Rising inventory would signal that physical supply is flowing toward potential delivery points, evidence that unwinding is proceeding successfully. Scenario 2, contagion and derivative stress. The frozen position is larger than currently disclosed, or similar positions exist in other accounts that have not yet been frozen. As unwinding begins, counterparties discover their exposure exceeds their risk tolerance. Margin calls cascade through the system. Banks that provided leverage to silver traders demand collateral. Those traders liquidate other positions to meet margin requirements. Volatility spreads from silver into related markets: gold, platinum, copper, base metals generally. Exchange intervention proves insufficient. Price discovery breaks down as participants lose confidence in settlement mechanisms. This represents the stress scenario, not collapse, but serious disruption that forces regulatory intervention beyond single position freezes. Circuit breakers activate. Trading halts occur. The process is messy. creates winners and losers based on positioning rather than fundamental analysis, and damages trust in commodity market infrastructure. Probability assessment, 35%, higher than many market participants currently acknowledge. The lack of transparency around total derivative exposure creates uncertainty. When uncertainty meets leverage, markets tend to assume worst-case scenarios until proven otherwise. Fear becomes self-fulfilling as participants reduce risk simultaneously. Business implications under Scenario 2 are serious. Companies relying on commodity derivatives for hedging should stress test their counterparty exposure. Can the banks and brokers on the other side of those hedges actually perform if market stress intensifies? Industrial users should consider increasing physical inventory holdings, even at the cost of higher carrying costs. When derivative markets malfunction, physical possession becomes paramount. The key indicator to watch: credit default swap spreads on major commodity trading houses and bullion banks. Rising spreads indicate market participants are pricing in counterparty risk, a leading signal that stress is spreading beyond the original frozen position. Scenario 3, physical delivery crisis and market structure transformation. Industrial demand continues exceeding available supply. The gap between paper prices and physical premiums widens beyond historical norms. Participants holding futures contracts demand physical delivery in quantities that cannot be met from exchange-approved warehouses. The fiction that paper silver and physical silver are interchangeable breaks down publicly and undeniably. Prices disconnect across different delivery locations. Shanghai prices diverge from London prices, which diverge from New York prices. Arbitrage mechanisms that normally keep markets aligned fail because physical metal cannot move quickly enough to exploit price differences. This represents transformation, not temporary disruption, but permanent change in how silver markets function. The current system, where a relatively small amount of physical metal supports a much larger derivatives structure, proves unsustainable. New mechanisms emerge, potentially blockchain-based tracking of physical inventory, potentially much higher margin requirements for paper positions, potentially separation of industrial silver markets from investment silver markets. The transition is chaotic. Fortunes are made and lost based on who anticipated the shift and positioned accordingly. Probability assessment, 25%, the lowest of the three scenarios, but not negligible. This outcome requires that physical supply constraints prove more severe than currently understood, and that industrial demand remains robust despite economic weakness. Solar installations and electronics manufacturing would need to continue at current pace even as broader economy slows. Possible, but requires specific conditions to align. Business implications under Scenario 3 are transformative. Companies dependent on silver for manufacturing must secure long-term physical supply contracts now, before transformation makes such contracts prohibitively expensive or unavailable. Investors should recognize that traditional silver investment vehicles, ETFs backed by allocated metal, futures contracts, mining stocks, will behave differently than physical holdings. The key indicators to watch: premium spreads between paper and physical silver widening beyond 5% and staying there, and announcements from major industrial users that they are building strategic inventories. Across all three scenarios, certain principles apply. Markets under stress reward preparation and punish complacency. The businesses that survive disruption are those that recognize warning signals early and act before consensus forms. The Shanghai freeze is precisely such a signal. It revealed that commodity market infrastructure operates closer to its limits than most participants realized. For decision makers with silver exposure, whether industrial users, investors, or supply chain managers, the strategic imperative is identical regardless of which scenario unfolds. Reduce dependence on derivatives that require counterparty performance, increase holdings of physical inventory where operationally feasible, diversify sourcing across multiple geographic markets, stress test assumptions about availability and price stability. The broader lesson extends beyond silver. When leverage in any market exceeds the underlying physical reality by significant margins, when concentration allows single participants to influence price discovery, when regulatory intervention becomes necessary to prevent systemic breakdown, that market is signaling fragility. Other commodity markets show similar patterns. Copper, nickel, certain rare earth elements, the same dynamics, paper claims exceeding physical availability, concentrated positions, exchange intervention, are present or developing. What happened in Shanghai on February 6th was not an isolated event. It was an early warning, a demonstration of how quickly markets operating near structural limits can shift from normal function to frozen dysfunction. The question facing every business with commodity exposure is not whether similar events will occur elsewhere. The question is whether they will be positioned to survive when they do. Markets reveal truth eventually. Leverage cannot indefinitely exceed reality. Paper claims cannot permanently substitute for physical possession. And when that revelation occurs, when the gap between derivative pricing and physical availability becomes undeniable, Those who prepared in advance will navigate the transition. Those who assumed stability would persist will discover that assumption was the most expensive one they could have made. The Shanghai freeze ended one chapter. What comes next will determine whether that chapter was merely interesting or whether it was the opening sequence of something far more consequential. The data is available. The warning has been issued. What decision makers choose to do with that information will define outcomes in the months ahead.